at kind of at a high level, what we're looking at, these solar tax credits, it's really a lot used for already realized gains and ordinary income to help you reduce the tax liability and create returns. So today we're going to talk about how you can use these solar investments to lower your taxes, some case studies, and some Q&A. But just some kind of basics before we get started to help frame this. So the big opportunity and that's really arisen and why we're talking about this is last year, there's a bill passed called the Inflation Reduction Act. Some of you may be familiar with it. The real kind of pertinent detail is the government allocated $369 billion towards tax incentives for renewable investments. And that comes in a couple of ways. But ultimately, that is a big reason why the ROI and the tax savings from this are so lucrative and why it's something that's coming up now. To double click on that, in particular, solar investments have really high incentives. You can receive up to 70% of your investment back in tax credits or more with leverage. Plus, you get tax savings from depreciation from that investment and income. Now, a lot of you may not know what tax credits and depreciation, how those kind of impact your tax savings. So just as a quick high level overview, tax credits are essentially a one-to-one write-off against your owed federal taxes. So instead of paying $1 in federal taxes, you can use a tax credit. So it's worth the equivalent of paying off $1 in your federal tax liability. Depreciation it reduces your income at a federal and state level. So it reduces your income, and as a direct result of that, then you're able to lower your taxes. But tax credits are more valuable. So ultimately, kind of all these investments, which we'll dive deeper into, it's a combination of tax savings from tax credits and depreciation. And then in addition to that, you also get income from these projects. But the core part of why these are valuable are the tax savings. The second thing to call out is just let us know if you have questions during the meeting in the chat. And so we'll keep track of those and bring them up when they're relevant or save them for the end. We'll try to stay on mute, but otherwise going to introduce Peter. So Peter runs the tax credits for Marcum, which is a national accounting firm, and has been working in the space for a number of years, particularly in tax credits, but also in the solar space. And so really understands the nuances, helps families, individuals take advantage of those. And so he can dive into what he's seeing, how people leverage these, and what are really the benefits and how it helps individuals. Peter, will hand it off to you.
Okay. Thanks, Monty. My name is Peter Downing. I'm the national partner in charge of credit incentives for Marcum. A little background on Marcum. We're a billion-dollar accounting firm, 10th or 11th largest, and we have 40 U.S. offices and about 4,000 employees across the U.S. I spend probably 80% of my time in the renewable space. John McElwee's on the call. He's kind of technically our client on these solar projects. John runs point with the developers. We work with about a dozen developers across the U.S. and projects range anywhere from 100,000, 135,000 to 35 million, and everything in between. We have access probably to 400 million of projects for this tax year. That's just kicked off, but people are out already locking down projects. And just some backdrop on the credit. The solar credit has been around since 2005. It's Section 48 of the Internal Revenue Code. It's tried and true. And what's really made solar kind of go, start gaining some popularity is the Trump Tax Act did two things. It reduced the corporate tax rate from 35 to 21, but the individual's rate stayed at 37. And they also made the panel subject to bonus depreciation or eligible cost. So not only do you get depreciation expense, you also get a corresponding tax credit. And when you take the two with the state credits, a lot of you are probably California residents like I am, you're getting almost 80% back from the government. And then you also, when you talk about cash flows, you also get revenues, and revenues can go anywhere from 15 to 25 years on these projects. So I call it mailbox money. It comes in, basically quarterly from the developer. And what happens is, by default, now the whole thing with solar is if you have passive income or passive types of income, then that's the best scenario. Then you don't have to do anything. What we end up doing is we have to make, to be active active in the solar business, you have to offset against active business income, flow through income, LLCs, LLPs, S corps. You have to be also active in the solar business. So we basically set up a solar holding company which owns the investment, and then you have to be active in that business, and that's defined as 100 hours. It's the third test of the passive activity rules, where you're spending 100 hours and no one else is spending more. You can do it with your husband and wife, they can split time, but basically you have to meet that 100-hour hurdle to take active depreciation losses against other active income. So that's just the caveat that's out there is, if you're not willing to spend 100 hours, then this is not for you. But again, a lot of our clients.
Let me just reframe that to kind of, so most folks get this, is so there's two big tax savings from all of these investments that Peter's talking about: tax credits and the depreciation. And they're roughly kind of equal if importance. Well, the tax credits are more valuable. The tax credits, you don't need to do anything to be able to save against your federal tax liability. But to what Peter's saying is the depreciation, there are limits on how much you can write off against your income if you're not actively involved in the business, unless you have other existing passive income. If you have other existing passive income, you can write off that depreciation against that. The tax credits you don't have to worry about. If you don't have passive income, then you can either spread out that depreciation and use it in the future against that future solar income, or if you want to use it up front, you have to become active in the business, and this is the 100 hours that Peter's mentioning. And I think there's I just want to make sure everyone understands that, of just essentially there's the tax savings, the tax credits, you don't need to do anything to get those tax savings. The depreciation, if you already have passive income, you can use the depreciation against that. If you don't, you have to get active in the solar business. Is that the right way to kind of restate that, Peter?
Yeah, well, technically the credits are passive too. If you're not active, then the credits have to go against passive income as well.
Okay.
So it's you're either it's like I said, we tell clients, you're in or you're out. I mean, it's one or the other. But I think the question popped up is, how do you get the 100 hours? Generally is you're going to go do a site visit with the developer. So that's a 3-day trip. So as soon as you leave your door, you're on the meter. So you'll get about 16 hours a day of travel time and meeting time. And then there's also a 4-day conference in Vegas. We highly recommend you attending. I think it's the second weekend in September this year. It's at the Venetian Hotel. That's a 4-day trip. That's all basically conference time. And then I have about 75 hours of webinars you can download and watch to your heart's content. And it's just documentation that, when you're doing a site visit, you take film, you take pictures, they're date stamped. In case of an audit 2-3 years down the stream, we need to have, a leg to stand on, saying, hey, we're active in this. You have active participation. Here's what I did. Here's my, training log, or whatever you want to do. It's nothing like you check a box on a tax return. It's just, you need this for your own CPA to say, hey, yeah, this is an active trader business, so he can take the depreciation against ordinary deductions. That's, once that's, that hurdle is cleared, then you're basically in the solar, kind of solar business. And a lot of clients pull through every year. They keep buying projects because once we get into the math, you'll see this is a better way to pay, to pay income taxes, and then also get a return from the government, on these deals. So let me just pull up. Isn't there a rule that says you are active if you do all the work? Yeah, the active, but you have to 100 hours is the minimum threshold for active participation. Like real estate professionals, you have to spend 750 hours a year. So somebody can't just go buy an apartment unit, rent it out, and the depreciation, it gets suspended because of either to rental income or you're not an active real estate professional. Let me go. So basically with the solar, there's 3 concepts, there's 3 mechanisms to do this. First is an straight asset purchase, where you're buying the physical asset. So you get the depreciation, you get the tax credits, and you get the cash flows for 20-25 years. The second transaction type are what they call partnership flip. That one has leverage. It already has predetermined leverage on it from the developer, from a bank. And basically the thing of it is you're the capital stack. So you're the equity stack that comes in. And I'm saying $1 million project that has 600,000 of debt, you're coming in with a 400,000 of capital stack, and that's good for 90. You'll get 99% interest in that partnership with the developer, but you're getting the credit and the depreciation based off of the $1 million, not the 400. So that's how you can get a higher than a 1-to-1 return involved with a partnership flip. And then in year 6, your interest flips down from 99% down to 5%. And then the third structure is what they call a sale-leaseback, where you actually buy the asset and then the developer turns around and leases it back from you for 20 years or so, and then you're getting roughly a 5% pref payment from the developer. So then you're getting a 5% return on that deal. But again, we're generally using tax dollars that you would have been sending to the government, and that's at the end of the day, that's really the key takeaway is if I owe $1 million of tax, and we can't offset every dollar of credit against your tax, you're still going to have to pay some minimum tax. But if we can knock your tax down to 200,000, you put that $800,000 from the $1 million, you put that into a solar investment, you'll get a return over 5 to 10 to 20 years on that 800,000 that you would not have received if you had just sent the money to the government. So that's kind of the 30,000-foot view on solar, how solar works on the commercial and industrial side. Let me pull up a project so you guys can see. Let me see. Yes. All right. Is it pulled up?
No, I'm not seeing it. Are you able to? You should be able to share.
Screen. Yeah.
There we go.
Okay. So this is an active live project that we have. Then this is a solar, it's a solar panel on a rink ice rink in New Jersey. So anyone who's, grew up in the Northeast, ice arenas are open from 6 a.m. to midnight every day. They take a ton of power. And these group of rinks are actually owned by a private equity group out of New York that have about 50 different rinks throughout the Northeast. And what they've done is they've gone in and said, hey, we're going to put solar panels on, and we'll get the benefit of the reduced power cost, but the actual asset, the physical asset, will be owned by an investor. So the investor would come in and basically pay 1.396, called $1.4 million for the project if they buy it outright. So it's $1.4 million to buy, and this is a 30% ITC project. So basically, the ITC, the credit on this is going to be $418,000, and you're also going to get depreciation over, basically over 5 years is another $439,000. So you're going to get $450,000 or $850,000 of federal benefits on the $1.4 million, plus whatever state depreciation that this doesn't include any state. But state depreciation would be your home state depreciation. If you're a California resident, you basically get the $1.4 million over 5 years as a deduction. So that will shelter out future California income or New York income or whatever state you live in. You'll get that benefit as well. And then you also get the revenues from the project. As you can see, the production from the rink, the power is about $26,000 a year of power from the ice arena. But what makes this project so attractive is what they call a TREC, which is a transitional renewable energy credit, and that's basically issued that comes from the state of New Jersey. So the state of New Jersey is basically the off-taker on most of the off-taker on this project, and they pay that over 15 years. It's basically guaranteed money based on kilowatt production on the production hours. So that's, essentially that's who's banking this over the next 15 years. But you can see as you skip out year 2, it generates about $80,000 a year of gross revenues. Now, again, there's certain expenses involved with maintaining a solar structure or a solar plant. You've got operations and maintenance, you have insurance, the developer will charge an asset management fee to take care of it for you. So, you're looking about 23,000 of expenses that are, incurred every year on behalf of the system, but it generates 80,000 of revenue. and you basically get, if you owned it, you get the net cash comes to you as a dividend. So you basically get this cash flow for 15 years. After 15 years, the state money runs off, but the system still produces power for another 10 or 15 years under the agreements. So you still get a revenue kicker, going downstream long term. But when you add in the state depreciation, the cash flows, you're getting a decent IRR on these things. Now, the second option,
I was just going to say, just to recap this. So how much in kind of are people getting in the tax credits? They're getting 420,000 roughly.
Yep.
And then they're in depreciation tax savings, they're getting an additional 440.
Yep.
And that's federal, right?
That's federal. Then state would be, 1.4 times at 13.3. In California, you're going to get another 160,000 of state savings. Yeah.
And so just to give people kind of context on this. So this project, you're investing $1 million for up front. Now, by the way, there's a range of these sizes that are significantly smaller to larger, depending on kind of what you need. Right. But in this case, you're putting in $1 million for. You're getting on the between federal and state tax savings, approximately $1 million. A little bit more than that between the ITCs, the depreciation, the federal and state level. So kind of you're getting $1 million in tax savings. And then to kind of what Peter's point is, you're getting roughly for the first 15 years, about $50,000 of cash flow. And then for 10 years after that, you're getting a lower amount of cash flow, but that's kind of the high level what those numbers come out to.
Yeah, and then, but basically, also too is any solar project, you have a 5-year holding period. So you got to hold it for 5 years and a day in order to avoid recapture of the credit. So we always bake in like 5 years of revenue during your holding period, and generally at that point in time, you're going to be pretty much break even or slightly ahead. When you take the revenue into account that you're going to get over the 5 years. And again, you're going to be pretty much break even. But again, that $1.4 million, if you owed $1.4 million to the government, that $1.4 million is gone in the wind. And in this scenario is after year 5, you have 10 years of gravy train money. Then there's still trailers at the end of 15 years. This is just a New Jersey state specific, because New Jersey recs are 15 years. But again, it's just an option. Clients like this because of the basically the state guarantee essentially on the revenue side. They're banking, that's basically a taxing authority that's paying you. So it's almost like a bond. And John's got a whole concept about, muni bonds and solar and how it mirrors, it's better than a muni on a return. And, you also have I'm taxed on that net revenue. Yes, you're going to pay tax on, but you can also very, easily, because you have a solar business and you're active, you can also open up a solo K retirement plan on this and just put that cash into that retirement plan, get a full deduction and not pay any tax currently. So, we can mitigate up to about $700,000 of cash flow on a project and basically on make it a tax-free deal in the short run by using pension plans and 401ks, solo Ks. So that, that's another conversation for another day, but that's option. And again, some people like to own things. They want to own it outright and they want the cash flow and they want the mailbox money. This net revenue comes in quarterly. Solar is a seasonal business. It doesn't come in 25. 70% of the sun production comes in the second and third quarters because of where we are in the hemisphere. First quarter and the fourth quarter are the lowest. So productions come in there. These revenue numbers are based on about 40 years of weather data from specific sites and everything. So they're pretty accurate on the number side. And, that's the asset purchase. Now, the second option is what we call a partnership flip. And the flip structure is you go into a partnership with the developer. So in the first 5 years, there's that holding period again. That's why they have it in the 5-year period. Is you basically going to own 99% interest in this partnership with the developer. So the developer basically says, all right, instead of buying 1.4 million, I'm going to go out and get bank debt of, 600,000 or so. And then you're going to do an equity contribution of 586,000. So that's the difference right off the bat is instead of paying $1.4 million for it of hard cash, I can get better results by putting in 586,000. So the 586 gets me 99% of the 418 and the 440. So I'm getting allocated on a partnership return. I'm getting allocated 99% of the benefits for the first 5 years. There is some phantom income in the first 5 years because of the loan repayments, so the principal are non-deductible. So there is a, you may have 20,000 a year of phantom income come through on a K1 in years 2 through 6, which you've got to pick up. But you're getting 800,000 or call it $1 million of benefit for under 600,000, and that's a 50% return or more on that money. And you pretty much get this mainly in the first year. You're going to get lion's share of it in the first year. The credits come the first year, and about 65% of depreciation will come in the first year through bonus. And then the rest comes in the over the next 4 years. But you also, but the other thing is you give up cash flow. You're only going to get a 1% return on your 586. So you're going to get a $6,000 pref payment every year for first 5 years. So you do give up some cash flow, but you make out, we have a lot of private equity guys do these. They buy down their tax rate with these flip projects. And it's just it's a stronger IRR. The only, there's good and bad with flips. The only downside is if the developer exercised the call option in year 6 and took you out of the partnership, since you have negative basis in your capital account, you have to pick that back up into capital gain income in year 6. But developers, the ones we generally work with, do not, they'll let you sit in this partnership for 20 years.
And then just to, sorry, I was going to say, just to kind of like give people the contrast of just how in kind of the first model that Peter was talking about, you invest $1 million for, and again, there's projects where you can invest less, and you invest $1 million for, you get roughly $1 million in tax savings, and most of that is upfront, and then you're getting these income payments on an ongoing basis. So it's primarily, the benefits are primarily the tax savings from the tax credits and depreciation, but then you also get a decent size kind of, as Peter was calling it, mailbox money that you're getting kind of a couple times a year. With the leverage model that he's talking about is you're putting in less. So in this project, you're putting in roughly $600,000, but you're still getting that same $1 million of tax savings, but you aren't really getting any income. So the income, there is a little bit, but it's marginal and not a big part of kind of your benefits. And then the other pieces down the line, you're going to have to pay when the developer buys back your equity, you're going to have to pay some of that back. But with the leverage model, you're getting a lot more in kind of immediate tax savings, right? In this scenario, you're getting roughly a 60% kind of ROI in the first year, which is why it's really kind of tough to beat.
But you're 400,000. Yeah, you're 400,000 ahead of the game. Yeah. I'm getting $1 million, $1 million of benefits for 600,000.
So there's a question in the chat that I think it's a good one. Is how can these go bad? Right, like what's the risk if the developer disappears, equipment is faulty, or if you take on debt? What's the risk there to someone investing in these?
Well, the risk is, if you look at where the revenues come from on these, and again, if you do the flip, your only risk is really your pref payments after year 1. Is your $5,000, $5,000, $5,000, your prep payment. If you do a flip, that's the amount really at risk, because the developers, basically the partnership is taking in all the revenues, but you just want to make sure there's enough cash flow coming in to pay the pref, which obviously there is. And then the second one is the T-Rex, remember, are paid by the state of New Jersey. So you have a state taxing authority that's paying you money. It's pretty much as good as the IRS. So you have the state government, the federal government. If the rinks go broke or they close down, but there's a thing called net metering. So every state, I think except Arizona, has net metering. And what happens is the PPA rate, which is the purchase power agreement that the rink signs up for, this is what generates the 26,000. If worst case scenario they close, the system stays with the building. So the building basically would still produce power, but that revenue now will be flipped over to the local grid in New Jersey. But they're not going to give you like a 7-8 cents kilowatt hour rate. They're going to give you a wholesale rate. So this 26 might turn into 13 until somebody else comes into the building. And that is generally a short-term issue. But you're not losing all your revenue. You'd probably lose maybe 15% of the revenue, because the state's still giving you the SREX, the TREX at $100 a kilowatt. So you're still getting that revenue from the state. It's really the top 26,000. Theoretically, that might get cut in half.
Yeah, got it. And another way of stating this is essentially what you're saying is that the ITC, so the tax credits and the depreciation, are essentially baked in all kind of
As long
all
as
these
it goes in,
projects.
as long as it's placed into service, which this would be a 2023 event, then the credits and the depreciation are valid.
Yeah, and so the only kind of, to the specific part of the question, what you're saying is the tax credits and depreciation, as long as the project goes live and it starts working, you're getting those. The only other piece is you have to hold the asset for 5 years, but otherwise the kind of at-risk piece, which is what you're calling out, is the electric income. And so, right, and that's the only piece that depends on usage, them not
And the panels, and again, there's operations and maintenance, there's warranty programs on the panels. The panels are generally warranted for 25 years. There's, ongoing maintenance, cleaning, things like that. And they're monitored by computer software systems. So if one module is not producing, they'll usually get a guy out there in a week to fix it and look at it. So they're under constant monitoring. So there's always, the light's always on somewhere with these things here. They've got insurance, they've got property and casualty insurance, they've got business interruption. So if it gets hit with a hurricane, a storm, and it gets knocked out, it gets rebuilt by the insurance company, and also your lost revenue gets paid by the insurance company. So there is very little other than going into service. That's really, the construction risk is really the biggest thing. And most of our projects have already been started. So they're under construction now. We don't do a lot of what they call NTP, is notice to proceed, where they're breaking ground. We'd rather be a lot later on during the process with an investor. And so we try to minimize the construction risk as much as possible. But again, if you do a flip, if you buy it, then you've got revenue exposure potentially. But if you're doing a flip, pretty much you're getting all your money, really in the first year. And again, you also use it for estimates, for paying down your estimated tax payments. You can take the economics of a solar project with the credits and depreciation into those estimates and not either significantly reduce them, or in the best case, you just eliminate them.
Yeah, and Peter, I know you've mentioned this before, but the risk, even though, so with this flip, there is debt on the project, but it's very little risk to the individual. Worth chatting through that as well.
Yeah, there's limited, it's going to show up as recourse debt allocated to you because, you're basically fourth in line. First of all, the revenues on the debt are guaranteed by the PPA and the TREX. So that's the first guarantee. The second is the equipment. The third is the developer, and you're the fourth. And I mean, so, really Armageddon's got to happen before, this happens. But, for tax allocation purposes, because you have negative capital to take those losses, you have to have debt basis.
Got it. Maybe it's worth running through kind of the third category. So we've run through kind of, you outright buy the solar equipment, the partnership flip, which is a leveraged one. The third category is the sale-leaseback, which is
sale-leaseback. Yep, and we got this here.
And probably I think the easiest way to summarize this is it's very similar to the first project where you're not taking debt, so there is a mixture of tax savings and income, but the income is much more consistent because it's based on a sale-leaseback structure.
Yeah. So this project came about to us a couple years ago. It was formed by a multi-billion-dollar family office in New York City. It had a better way, to do new home developments. That's really what this goes after. It's not the easiest thing to retrofit street poles with solar when they're already out there and built and things like that. So these are new construction, new developments in Southwest Florida, Tampa Bay area, Naples area of Florida, and they were national home builders. So basically the family office went to these, Pulte's, the Ryans of the world, and said, hey, guys, there's a better way. You're putting in 4,000 homes in this tract in Florida. You're going to need a ton of streetlights. So one of the biggest expenses on the development side is trenching and digging and running lines in the, when they're pre-construction, they got to put all this stuff in the ground. Where now the developer doesn't have to do that because these are just freestanding. Every pole is its own unit, and it, basically, it sits in pins on concrete. The pole gets, gets installed on the sidewalks. So there's no trenching cost. The developers save millions of dollars on this. They don't have to pay that. That's all bottom line savings. Then they turn around, because they all create these HOAs and these new developments. They turn around and stick the HOA with what they call a lighting service contract. So the HOA pays the family office or the development company, the solar development company. They pay them on a fixed fee per month per charge on each pole. And they're saving under the LSA, they're saving about 20% of what they would have had to pay Florida Light and Power. Because if they didn't do it, if this wasn't available, they'd have to pay the electric for all the streetlights because it's community property. And then the third thing is the developer gets all that revenue, takes care of all the maintenance, has insurance, does all the billing collections. And what they do is they turn around you buy the poles from them. Then we call them like Legos. They're $9,000 each. So the minimum pole order is 15. We have clients that have done well over $1 million of poles, and they basically will pay you. You get a credit on it. You get depreciation, but you also get a 5% pref on your invested capital. So the thing of it is, you got a 5% bond out there for 20 years. So it's a great thing. For full disclosure, John and I own poles individually, and it's a great concept, and we use it for tax mitigation. But basically, the economics work out on 135,000. I'm going to get federal depreciation of about 40 grand at 37. And that's going to be roughly 32,000 is in the first year with bonus. And then the remaining 11 or so comes over 5 years, because there's a 20% piece that's now 5 years in 2023 with the way the bonus depreciation is. For a California resident, you're going to get 17,000 of depreciation expense over 5 years on the poles. So depreciation is going to cover 57%, 57,000 of the 135 over the 5 years is coming from depreciation. Then the second thing is a tax credit. So the poles are assembled and manufactured in the US. So there's a component part in the IRA that gave a 10% kicker for items that are, made here in the US, installed here in the US. And if long as the component cost is greater than 40%, which it is, then we have that 10% credit hurdle. So on top of the 30, we get another 10%. So it's a 40% ITC on the poles. So the credit's going to be $54,000 in the first year. So when you take that with the depreciation of 57, you're getting $111,000 of benefit on the 135 from the government, from the federal and state.
And that's just tax savings, right? That's
tax effective tax savings. Yes. And then you're going to get a coupon, which I go, basically 6750. You're going to get that every year for 20 years of cash flow. So again, the math's all linear. We have, you can buy 135,000 of poles, or we could do 500. It just, we marry it to what each individual situation is. But you come down to the end, you're getting 32 grand of bonus in the first year. You're getting 8,000 of depreciation, federal depreciation over years 2 through 5, 18,000 from the state of California. You're getting the ITC of 54, and you're getting 135,000 back over 20 years. So it comes out to about a 17% return for a California resident, cash on cash on the invested capital.
Yeah, and so this is just like another way to just frame this of effectively, if you invest $135,000, you get $112,000 is tax savings in the first 5 years. So you have $25,000 roughly at risk after tax savings, and you're getting 5% a year for 20 years. Roughly, kind of to look at the math. Kind of question that just came up is, do the federal tax benefits of this apply to US expats living in Europe? So assuming, and I'm assuming this person is paying US taxes.
US tax.
Yeah.
You would just have to be, and again, to use this, you would still have to be active in that solar holdco. So you'd have to go, you basically do a trip. John's been down there 3 or 4 times with clients. giving him the dusty shoe tour at the developments. But that's a 3-day piece that takes a lion's share of the hours out. But again,
So
it comes, you still got to do the 100 hours, then you got to do the projects if you have active income. Or the other thing too is there's also this excess business loss. So, Monty, you had talked about, there's two bad parts of the Trump Tax Act. One was a SALT deduction cap, and then the second one was this excess business loss thing they threw in. And this excess business loss is you can only deduct $578,000 of excess business losses against W-2 income or other types of income. But if you've got somebody who's a W-2 employee and they make $1 million, they could basically buy 700,000 worth of poles to get the maximum bonus of 579 to take out that, using that threshold to offset the W-2 income.
Yeah. And so just to kind of summarize that, so it does apply to the federal taxes. The big kind of constraints are to what Peter's calling out is being active, if you have passive income from kind of the things he mentioned, then this is the constraint. If you don't, most people don't, then you have to spend 100 hours. And then depending on your income, this is where that limit of what he's talking about may come into play, of how much you can write off in a given year. But one additional note to add there, right, is Peter, you can carry these forward for 20 years. So let's say you have more than you can use, you can carry it forward, correct, for 20 years. Is that the right number?
Well, effective January 1st, the carryback now can go back 3 years. So you can carry back the excess credit 3 years back to 2020, and the carry forward is now 22 years. So we have clients that they want to go pick up prior year tax, and so you'd really have to like kind of overbuy this year to wipe out your income, and then take the credit back, because that tax paid in the prior years is permanent and never going to get it. It's permanently lost. So if you have people have the means to do it, they do it.
Yeah.
So if they got to spend a little more money this year to get the to buy extra projects, then they'll do the carryback. But again, that's going to be, theoretically, you would have the money probably for 2 years, 2.5 years, because just the way the functionality of it is, if you do a 23 loss, you file in 24, then you do your carryback claims next fall, it would be 25 until you would see refunds from the government.
So essentially the government is slow, so working backwards.
Oh yeah, I mean that's how the process is. Yeah, it's not quick. The government wheels, they grind slowly, but they do grind fine.
Yeah, and then to kind of, this is a separate follow-up I got, is so you mentioned the majority of the tax savings are in the first year. Do they have to stay active for all 20 years, or is it just for the first year, or how many years do they have to stay active for?
The technical answer is they have to be active if they're claiming depreciation. So it's a 5-year run. They would have to be active every year. That's the technical answer. Got it.
Okay. And can they use the depreciation against the income from this project?
For
the when they're getting income. So if they have for years 5, the depreciation write-off, can they use it against the income from this project?
Yeah, totally. Yeah, because we'd all go through that entity. That entity would get all the revenue, and then they would have the expense. You'd have a small sliver of depreciation at the federal, but California or state, you'd have over 5 years. So state, you would always run a loss. Yeah,
got it. Okay.
I've got a quick question. Peter and my thanks a lot. This is really interesting. I'm trying to get this is a kind of a complicated question, but maybe you can give a couple sentences on this. How does this tax strategy sort of compare to other tax strategies people take? For example, real estate or trust strategies. Just trying to compare this to like other things that are out there. It certainly seems like this has the benefit of it seems easier to qualify as an active participant than real estate's, becoming a real estate pro.
So it's a lot easier than real estate. It's a lot less brain damage than an easement. Conservation easements they're out there, but my personal opinion on easement, unless it's on a golf course, it just doesn't. you see a lot of syndicated stuff with sulfur farms in Georgia that have no economic bearing, and they come up, and the IRS is really pursuing those. It's not on the dirty dozen list. And again, you take a holistic approach on solar. Is at a high level, the government just sunk in $370 billion behind it. The energy production that from the U.S. grid is only right now is about 3% of solar from renewables solar, and they want to get that to 30%. So that's a 10x multiple for the next decade, and that's something we'd like to be involved with. You have corporate ESG movements. Companies are going to be required to stop buying energy credits just for ESG purposes. They're getting pressure from folks like BlackRock, who control, I don't know, $57 trillion of global net worth. And they're looking, and they're not making, they're forcing their portfolio companies to, do the right thing on the ESG side. So it's a whole movement. I think, my kids' generation, they're definitely into this stuff. It's just, if you can make a couple bucks and help save the planet and and do the right thing, it's worth it. But again, it's not a listed transaction. It's a great thing. Just nobody really knows, people think it's solar, like, I put panels on my house, I get a credit. But when you take on the commercial side, when you take depreciation, credit, and cash flow, it's like a muni bond on steroids. The only thing is, you got to do 100 hours and you got to hold it for 5 years. Those are the two criteria. And really, we made this product available for folks that, maybe make $500,000 or $1 million a year, where generally to buy a solar project, you got to pay $1 million or more for the project. And that limits, you're dealing with the 1% of the taxpayers. People ask, this is too good to be true, but it's, you have to have the tax liability and you have the liquidity because you got to pay for it.
Yeah. And the one thing I'd add here is that the returns on this relative, there's not a ton of great options for ordinary income. W2, right? Even here, whether it's 100 hours, there's plenty of other options for capital gains, things like that. This is one of the one of the better options in terms of the returns you can get from writing off your ordinary income. And this is to what Peter's saying. A lot of this is just the government has created a ton of incentives, and that's what's bolstering the return. If there weren't these incentives in there, the stuff wouldn't make sense. And this is where it's really just between the federal and state tax savings. That's where the numbers come up in. And it's the returns are really are some of the best you're going to see out there relative to also, this is where it's, Peter mentioned this, conservation easements can also have potentially high returns, but there's a lot of risk with them versus this is much more straightforward. It's hard to say compared to everything out there, but it is one of the better options for.
And again, this is not
ordinary income.
And it's not, we don't call it an investment, it's a tax mitigation strategy with a return. Right. You can get better returns while the stock market's getting pounded today, but it's you don't have to worry about
Manny, let me jump in here. This is John Mack. So just again, it sounds like we may have a few real estate investors, and I've been in this space for close to 15 years now, and 15 years prior to that in the real estate world. So I liken this to a triple net lease with the sun as your tenant. Although the counterparty is really the user of the energy, but just think of it in this construct. You have a developer who's going to be the property manager. After you get into a deal, they're going to manage all the hardware and software, make sure everything is functioning correctly. You're going to do your 100 hours through site visits, through conferences, through some other educational things, through investment committees, et cetera. You have one tenant, shows up for work every day. If it doesn't show up for work, we've got a different issue we're all going to have to deal with. But most days, even in the Northeast where I'm from, the sun comes out, 200 plus days a year and produces the power that therefore produces the revenue. But just go to the fundamental element about the difference between this and a real estate investment. In real estate, you are hoping for appreciation, and you do have depreciation that you can write off that investment, even with accelerated right now. In this, you get the extra bonus of a tax credit, as Manny said, dollar for dollar tax credit. So 30% of your money is coming back through the tax credit up to 70%. Let's just say the poll idea, which Peter showed you, that's 40%. So 40 cents on the dollar, you're taking off the table day one. Another 30 cents is roughly taken off through depreciation over, either in the first year or over the first 5 years. So now you have an investment. And again, look at muni bonds. You're locked in for 10 years. You're going to get a 3-4% rate, depending. With the taxing authority, you're not getting your principal back for 10 years. In this scenario, you're getting 65, 70 cents on the dollar back year one, and year one can start with your next estimated quarterly. So there's an accelerated return right out of the gates. And again, going back to the sun and production, this is 30 years plus of weather data. We know what it's going to produce. It's always underestimated, generally produces a little bit more, and you're tried and true for the next 20 years. The same technology, although this has been following Moore's theorem as well, where the technology production increases every 2 years, price gets cut in half. It's been following that same trajectory up until COVID. Technologies always get better, but we still have panels that are in the atmosphere that have been running and operating for 55 years, fueling satellites and other things that are in space right now. So this is something that somebody can come out with a better whiz bang in 5 years or 6 years, or maybe a high school kid in their garage right now, but this is still going to produce. And it's still going to produce energy at a lower cost to the user. And it's going to be consistent and persistent for the full 20 years, 25 years of lifetime of the investment. So I look at this relative to other investments. I think that was the premise of the original question, as relatively safe. And again, you're getting 70 cents back on the dollar from the government. In the case of New Jersey, you're getting another of that 30 cents, you're getting another 20 guaranteed by the state. Most of our off-takers are schools. This HOA is backed by a CDD, Community Development Authority, in Florida. So there's always a counterparty that if everything fails, and that was one of the other questions, what are the risks? The power is going to go back to the grid, or somebody's going to buy a new building, take the system, and use it because their cost of energy is significantly lower, mostly 10 to 20% right out of the gates for the use of the power. So I'll leave it at that. I just wanted to kind of address a couple of the questions. We're dancing around the same thing, and hopefully that was a good overview of the way that we see this type of investment.
Yes, thanks to both of you.
Awesome. Any other final questions? Okay. One other one that came in is that 100-hour rule, Peter. So this is this an IRS rule stating of how people can, the passive income limitations, or what exactly is a 100-hour rule of kind of?
Yeah, if you pull in, I think it's publication, it's 569 or so. IRS has a publication out on passive activities, and there's 7 tests that in order to be treated as non-passive, you have to pass one of these tests, and that's the third. We're using the third test of the 7 is 100 hours, because what happens is people ask, hey, can I go in with a partner? If it's 5 or fewer, then everyone's got to do 500 hours. So that's a problem. We created using the single member LLC structure. We created this to get around those passive activity rules. Because everybody would I love to use the losses, but it defaults as passive. So to get around that, you got to be active. And how do we do that? And it's a single member or a multi-member with a spouse or a trust. So depending upon everyone's tax situations, where they report the income on the tax return. If you're getting a K1 income on Schedule E, page 2, we want to marry up that K1 to go to that line item, so it's clean on the return. So we customize all, everybody's solutions are all customized to their individual situations. We spend a lot of times with their outside accountants, because generally they're not Marcum clients. So we walk the CPAs through here's how they get active, this and that, and this is how it works. And then they get, then once they get comfortable on board, then the people, clients will, all right, they'll push the button and get it done. So what we do all of that, we're paid by the developers. So there's no out of pockets for our stuff. It's all, we're paid by the developer. The only out of pocket really is setting up the entity and reviewing the legal documents. So depending upon the structure, there's different sets of documents, but that's really the only out-of-pocket cost, and that's deductible at the entity level. So.
Awesome. Appreciate that, Peter. And I know we're running up against time, so appreciate everyone joining. Kind of, if you're interested in this or learning more, we'll send a follow-up with a list with a link where you can sign up to schedule more time, ask any questions you have, and we can get you set up if you want to invest in one of these or just learn more. And we'll go from there. In addition, after this, we'll send a recording of this webinar. So if you have questions, want to rewatch it, and some additional materials, just so that if you want to read deeper into this or look more into some of these numbers of what are the returns and if it makes sense for you. And again, appreciate everyone joining. Appreciate Peter and John